G'day there, Wealth Press subscribers, investors, traders, and watchers. We're here for another midweek conversation with Lance Ippolito. Lance, how's it going?
Lovely, lovely. How are you?
Rocking the free world over here. We'll talk about the big IPOs today. DoorDash, Airbnb. How are they performing?
Uh, so Airbnb is now, I just got a news alert saying they're indicated the IPO to be 150 to 151 per share. I think just the other week it was what, in the 40s a share? So we're looking at about a triple and at the open. So,
Wow.
Nothing to see there. And DoorDash traded up to 195 yesterday. And yeah, that was pricing in, I think, in the mid 80s, and then earlier in the day around 100. So, nothing like a smooth double for the early money to get in.
Cool. And so what else is going on in the market? Where is money being made today? Where is it being lost?
I think the bubble IPOs are the play, but unfortunately for most folks out there, there's no way for them to get in. We saw tech sell off yesterday after Dash went public, and it's like, hey, everyone, sell every tech stock you have and buy the next IPO darling, because any excuse for growth, Wall Street will buy it.
Yeah. I've jumped on the SPAC train. I bought 3 SPACs this week.
Oh,
And all of them are, so one of them did the merger. One of them announced their merger date and the stock went up by 40%. So that one's sitting nice. The other one completed the merger with the company and started trading under the new symbol and promptly dropped $1, but it's coming back. And then the other one is having its meeting vote on December 14th. So stock's kind of fluctuating in here, waiting to see how real that gets. But so tell me, are you interested in the SPAC trade at all?
I feel like I missed the boat, and then they had a big run up. They kind of cooled off, and now they're back on the rise again. I have a couple that I've traded in and out, but I could have made a lot more money, put it that way. And then one name, which I was really kicking myself in the behind, was QS. It was Quantum Scope Corporation. Have you heard of that one?
Nope.
So that one was, I think the ticker was KEAC before. And there was a lot of option flow hitting the tape. So I bought stock because the options were really wide and expensive. And I made a few $100 within like a couple hours on the stock. So I sold it. I'm a trader, short-term trader usually. And then the next day they announced their merger got complete under the new ticker symbol QS. And the stock went from like $24 to $50, and a few days later it was at $87.50. So that would have been a large payday, and the options, if I would have held, would have been, oh god, probably 10-20x, something outrageous. Ever since then I've been kind of, I'm not gonna lie, salty and bitter about the SPACs, because I've been I did not do my homework on them, and I did not go in on them like I should have. And now I feel like the train left me.
Yeah. Well, there's a whole bunch of them continuously coming. And the thing that caught my attention was NASDAQ's website under the SPAC sort of listings portal. It indicated that 75% of the SPAC IPOs had been successful. In other words, the stock price today was higher than when they merged with their SPAC. And so I thought, well, that's pretty good odds. It doesn't seem like it's that great odds in this era of everything going up, but still, you know, the SPACs tend to, in some cases, double shortly after the merger, because it takes a while for the market to assimilate that, oh, okay, this SPAC is now this company. And so this company's balance sheet is now this SPAC's balance sheet. And so it takes a while for the market to sort of filter that information through and say, oh, this is undervalued, or this is overvalued, or hey, this is just a hot sector, let's buy it. So this is my sort of approach to it. I'm not so much a intraday trader or even a swing trader. I've become a shorter term investor, but I'm still an investor in that I pick my price entry points based on the fact that I think there is greater value in the stock, and that value will be expressed in the share price within a given time frame, 3 months, 6 months. It used to be, you know, I'd be like 3 or 5 years, and I still have a big part of my portfolio that's 3 to 5 years. But increasingly, I'm interested in these shorter term hits where, you know, these SPACs especially are doing upwards of 100% lift within 90 days of the merger. And so I'm trying to, I'm experimenting with seeing which of those I can hit. And interestingly enough, the ones that seem to do the best are the ones that are trading more on hype than on value.
It is, like you said, so much hype surrounding them. And I think anticipation, you know, it's not necessarily, hey, well, look, you know, this is the balance sheet, or this is the fundamentals. It's almost, what can it become in the future? And I think it's, you know, a popular thing right now, because we are seeing more and more companies use that route to go public. And I think if you look at the IPO market, like Dash and Airbnb right now, people are realizing like, oh my God, you know, these stocks are moving up so much on the IPO. Well, I can buy some SPAC and hopefully get some, you know, crazy return like that.
Right. So do you think that the SPAC trade has for now displaced the option madness that has been characterizing much of the action in the markets lately?
You know, if you look at, like, let's just say like your big tech, like Facebook, Apple, Nvidia, Google, Amazon, they haven't really done anything over the past couple months, but what has? SPACs. So it's almost like the fund managers are saying, well, hey, we have so many of these big tech companies, we don't really have any new names to add, and we don't have any really new growth stocks. So now let's just go and find this new company. And the hunt for growth is so high right now that I think you're seeing such a large shift into them, because you know, there is return in them, and they have gone up so much. So I do find it very interesting, especially if you look at, like, you know, the NASDAQ's making highs, or, you know, yesterday we pulled back a little bit. But if you look at like a Amazon or something, the stock hasn't done anything since really July. And it just goes to show you, it's like, you know, where's their leadership in the market? Usually it's, you know, tech. Well, now it's kind of SPACs and growth out there. It's, you know, it's a phase. Is it, you know, a bubble? I don't know. We could say that about EV names, and you still have a lot of EV names holding up well. So I just think it's a new shiny toy, and they have been working out very well. So can't really hate on them.
Sure. You think the valuations of the incumbent tech stocks, the Teslas, Amazons, Netflix, Fangs, et cetera, is starting to just alienate investors by the virtue of the fact that they're just so freaking expensive that it's like you can't drink that Kool-Aid without getting a bitter taste in your mouth and a lot of nervousness and sleepless nights, because it's just so overvalued. So for me, it's like, well, I really feel like I missed the tech boat as an alternative asset investor primarily, but I'm not going to chase tech. The SPAC boat has recently sailed, and I wasn't there, you know, for the grand foofara at the beginning. I missed the first few. However, I think that the SPAC sector is going to remain robust and frothy, because the long in the tooth bull market of the NASDAQ 100 is just starting to become too much of a victim of its own success. And with more stimulus coming, which means more higher liquidity loads on all markets, investors are going to look for where they're going to get the big bang for the buck, and it's not going to be the NASDAQ 100 in 2021, in my opinion. What do you think?
I do think the NASDAQ will hold up. Like, you know, do I think the NASDAQ's going to go up 50% in 2021? No. You know, 10, 20% realistically, sure. Like, I don't think that's a problem. But at the same time, it's, you know, how much can people really chase these stocks? You know, they've rallied so much, and there's nothing really new about them, right? And you look at the growth stocks, or we'll say SPACs in this example. I mean, they're still undiscovered technically. You know, there's no really correct way to price them. And there's a lot of, you know, blue skies ahead. A lot of these are lower price stocks too. You know, they're not $2,000 or $200 stocks. So, you know, I think the IPO, the SPAC market, I just think it continues to boom. And you know, we've seen that with recent IPOs that have happened that are now, you know, taking a second wind to the upside. Like you know, Planters is a good example, PLTR, ASAN. Another good example, it's up 11% today. And if you just look at the, you know, the SPACs that are trading, volumes picking up, demand's picking up, share prices are rising. They're starting to get more and more coverage on them. So you know, I think they're here to stay, and I think it's going to be one of the names when the market does dip. You know, if we see a 3-4% move lower in overall markets, sure, they're going to get hit. But if you continue to see them just getting bought right back up, it's going to be, you know, kind of like tech was since March. Buy the dip and ride it out. Buy the dip on any weakness.
Right. Okay, so then going into this final month of 2020, which, you know, it's interesting to me that there's so much social media that basically says 2020 sucked. But if you're in the stock market, 2020 was probably your best year ever. And for me, 2020 was my best financial year, not ever, but certainly for the low effort, high reward with low risk.
Yep.
So it was a good year. I didn't get COVID. Nobody I know has died of COVID. I live in a small community where it seems like it's you know, it's a thing. It's a big city problem. It's not our problem because we social distance here in the country just by default. So, you know, nobody really socializes indoors out in the boonies. We all stand around in the barnyard. And so, you know, it's been a great year. But 2021, I'm afraid that now the vaccine's here, you know, all of the financial stimulus that has been driving liquidity and making volatility to the upside predictable is going to go away. And that's going to make 2021 a bad year, if you ask me. So where do you think 2021, like, we got SPACs, we got the IPO trade, we got the NASDAQ, we got the Russell. Where do you see the biggest opportunity in 2021 from where we stand right now?
You know, I would say look at banks, look at metals and mining, you know, some steel names, some basic materials. But problem is, over the past 3 or 4 weeks, they've already lifted. And you've had like steel names up 70, 80%. You've had basic material names already rallying 30, 40% in weeks. So they're back to where they were pre-COVID, if not higher. You know, looking a couple months ago, I would say, well, you know, the catch-up trade, right? The beat down sectors have to take some leadership in the market and rally. It already happened though. So now it's like we're back to square one, where everything is here. Like everyone's at the same starting line, and sadly, it's the starting line's basically at the top. So you really don't have anyone in front. You don't have anyone behind starting the race. And the easy money's gone. I mean, if you bought call options or just bought stock since March and just close your eyes, eventually it would go up, almost any stock, right? And now it's to the point where I think you're going to have to get way more selective, and you almost have to anticipate that, you know, there will be some kind of headline news or pullbacks or you know, not just a straight line up, basically. And that's what makes it hard to, I think, everyday folks, that now they have to time the market, where before it was more of just, well, I got some cash, let me put it in the stock market because I'm going to make money. So that easy money, I think, is gone. And there's no reset. There's no opportunity wise. That's where it becomes, you know, a concern. Like, I don't want to put money in the stock market right now. Like, when I trade, I'm doing short-term trades and I'm in and out because I just think, you know, the easy trade is over. It's hard right here. It really is. And saying what will 2021 bring, everything's kind of strong. And you know, you look at VIX, the volatility index, it's still holding $20, but you know, right now it's all stimulus chatter. You know, if we get a vaccine, if we get a stimulus, there should be more money into the market, but damn, you know, is it going to be SPACs and IPOs and tech to lead the way all over again and just wait for that other leg higher? Possibly. Man, right. It's just, it's hard buying up here, you know, a stock that has ran 40-50%. Yeah. And that's what's hard is training yourself to think, well, I should have bought earlier. Let me wait for a pullback. And what pullback? You know, you're going to get 2 hours of a pullback on a Wednesday afternoon, and then that's it. I mean, that's timing. That's hard timing.
Yeah. All right. Well, let's leave it there for now, Lance. We'll ponder our belly buttons for another week, and we'll talk to you next week and see what we can come up with in the great wide world of sports trading. And we'll talk to you later. Have a great week.
Thank you. Have a good one.